Hi everyone, this is Greenspud Trades. Last week marked a major shift in the retail brokerage industry. On Tuesday, October 1st, 2019, online stock brokerage firm Charles Schwab announced that it would be eliminating commissions on all U.S. stock, ETF, and options trades. Two other major online stock brokers, TD Ameritrade and E-Trade, quickly followed suit, also bringing their commissions down to $0. In this video, I'm going to explore how the business model has changed for these companies and what it could mean for retail investors and traders. In 2013, the launch of a new trading platform named Robinhood brought a new wave of disruptive innovation to the industry. For the first time ever, a stock brokerage company was offering commission-free trades. They also had a well-designed smartphone app, and these features helped Robinhood gain popularity among the young millennial crowd of investors. Robinhood is now one of the most successful and fastest-growing fintech companies ever, with a valuation of over $7 billion in 2019. However, this company's business model could not even exist if it weren't for behind-the-scenes changes in the stock market that have unfolded over the last 10 years. As computers have become more powerful and stock exchanges more automated, businesses called high-frequency trading firms have taken advantage of these changes by using computer algorithms that capitalize on very short-term opportunities based on the computerized order flow. These high-frequency trading firms like Citadel, Knight Capital Group, and others claim to perform an important function called market making, in which a firm is doing both buying and selling of a security, intending to make a profit on the bid-ask spread in the price.
Typically what happens, one of the reasons that many brokers have been able to keep the commissions very low is when they get an order from you that's what we consider a marketable order, buy on the bid, sell on the offer, or take the offer, hit the bid, or market orders. Those orders, someone will pay them for that order flow. The market makers will pay them for that order flow, basically to have the right to see that order first, hoping to capture the spread. If you capture enough order flow, you can, if you pay out a tiny fraction and can get a bigger spread, you can monetize that in many ways.
This activity is so important to providing liquidity to the markets that some market makers are even employed on behalf of the exchanges like the NYSE and NASDAQ in a role called the specialist. But the high-frequency trading market makers of recent years are able to take market making to an entirely new level. Using sophisticated computer algorithms and proprietary hardware, they are able to analyze the incoming order flow and quickly determine how to respond in a way that's profitable for the market-making firm, either by filling the order, adjusting the bid-ask spread, or routing it to another exchange. Proponents of this practice say it's good for the industry because it provides liquidity and makes the market more efficient. Stockbrokers like Robinhood, and even established firms like TD Ameritrade, make a significant amount of money in kickbacks by routing their customers' order flows to these high-frequency trading firms like Citadel. It's a practice called payment for order flow. These kickback payments are enough that it enables a brokerage like Robinhood to offer free trading and still cover operating expenses. Robinhood is a privately held company, so we don't know exactly what kind of money they make from order flow routing. But their competitors like TD Ameritrade also engage in the same practice, and we can see their financial statements. By looking at TD Ameritrade's latest 10K filing, we can see that in 2018, 36% of their revenue came from commissions and transaction fees. At first glance, it might sound like all of this money is derived from trading commissions that they charge their customers, but this figure includes something called order routing revenue, which they describe as a type of transaction revenue, which results from arrangements that they have with many execution agents to receive cash payments in exchange for routing trade orders to these firms for execution. In other words, the company's receiving kickbacks for sending orders to the market makers. In 2018, of the nearly $2 billion in transaction revenue, almost a quarter of that figure comes from order routing revenues. The proportion of order routing revenues is also a fast-growing part of the business, having grown 43% in 2018. With the increased number of trades that will most certainly come now with free commissions, maybe payments for order flows will make up for any lost revenues. If you want an even finer level of detail on who these market makers are, you can view the company's SEC Rule 606 report, which names the firms to which TD Ameritrade routes its orders. As you can see, Citadel Execution Services takes almost half of the orders and sends back an average of 0.015 pennies per order. High-frequency trading is a controversial practice because some people believe these companies are exploiting market structure loopholes in a way that gives them an unfair advantage over other market participants. Opponents say that retail investors and mutual funds investing on behalf of ordinary people are losing returns on their investments because these high-frequency firms are able to front-run their orders, chipping pennies away from each trade.
The best analogy, I think, is that your family wants to go to a concert. You go into StubHub, there's 4 tickets all next to each other for $20 each. You put in an order, buy 4 tickets, $20 each. And it says, you bought 2 tickets at $20 each, and you go back and those same 2 seats that are sitting there have now gone up to $25.
TD Ameritrade is currently fighting a class action lawsuit alleging that their order routing system has caused losses for clients by not providing the best execution prices. The market-making firms also have come under the scrutiny of regulators, which in one case has led to a $22 million fine for Citadel. Regardless of whether or not you think it's good for the market, payment for order flows is an incredibly profitable arrangement for both the high-frequency trading firms and online stockbrokers. Citadel, the leading trading firm in this kind of trading, has made its founder Ken Griffin the wealthiest person in the state of Illinois, with an estimated fortune of $11.7 billion. Ironically, the very same week that 3 major online stockbrokers announced $0 commissions, cementing their reliance on payment for order flows as a source of revenue, Ken Griffin made a $125 million donation to Chicago's world-famous Museum of Science and Industry, which will result in the museum being named after him. So what do you think now about the $0 stockbroker commissions and the role of the market-making firms that make them possible? Is high-frequency trading a good thing that is resulting in a win-win for both Wall Street and individual investors? Or are investors now paying a hidden cost every time that they place a stock trade? Leave your comments below. Also, don't forget to subscribe to my channel to get more content like this. I don't post frequently, and therefore don't get promoted by YouTube as much, so hit the bell to be sure that you get every video. Leave me a like, and I'll see you on the next video.
Well, remember, your excess returns come from market inefficiencies. And the work that everyone has done over the last 30 years to commoditize news, data, and information means that our markets today are much more efficient in the short run. Transparency is what creates confidence. Confidence that you've been treated fairly, confidence that you understand what's taking place in a marketplace. Transparency is the underpinning of a healthy capital market.